Howdy, everybody. Welcome to Liberty Call. Today is Friday, June 14th, 2024. I am Raymond Dahlman, your humble host here at the Liberty Call. Hope you, yes, you are having a fantastical day out there. It's kind of rainy here in Colorado. We got some storms coming through and thunderstorms, and you kind of see Jake back down here. He's hiding. He doesn't like thunder. It makes him nervous. He didn't grow up in Texas like my first dog, Barney, who living in Houston. Thunderstorms are just part of living, along the Gulf Coast. Didn't bother him in the least. He didn't like fireworks. This guy, Jake, hates thunderstorms. Freaks him out. We don't get a lot of them here in Colorado, only in the summertime. So anyways, he loves the snow, though. He'll go out and play in the snow all day. All right. Well, if it is your first time watching Liberty Call, yes, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right, let's go ahead and jump in and see how the markets did or finished up the week. Mostly red. Dow Jones was down 0.28%, 108 points, closed at 38,538. The S&P 500 was down 0.16%, 8 points, closed at 5424. NASDAQ up 0.01%, so basically flat, closed at 17,668. The VIX was up 5.03% today. It's at 1254. Canada down 0.32. Brazil up 0.1%, and Mexico down 0.17%. In Europe, Germany was down 1.34%. The UK down 0.21%. France down 2.66%. Whew, it's pretty big. Netherlands down 0.64%. Spain down 0.67%. Italy down 2.81%, Switzerland down 0.44%, and Portugal down 0.42%. Russian exchanges both green today. The MOX up 1.33%, the RTSI up 0.35%. Overnight, the Nikkei in Japan was up 0.36%, Australia down a third, New Zealand up 0.01%. In China, the Shanghai was up 0.12%, the Shenzhen Component up 0.5%, China A50 up 0.49%, DJ Shanghai up 0.2%, Hang Seng down 0.94%, and the Taiwan weighted up 0.86%. So yeah, it's been a weird week. Let me bring up the chart here. Let's go to the weekly. And it was just strange all week. I mean, we would have these days where Monday was pretty just flat, but Tuesday, the market opened way down and then, came up at the end of the day. Wednesday opened way up and was down the rest of the day. Thursday opened down, finished with a rally. Same thing here again today, way down, and then it rallied. It very, very weird. So, all right, let's go ahead and see how these indexes did for the week. Starting out with the Dow. The Dow Jones is going to finish the week down about 0.5%. The S&P 500 is going to finish up 1.55%. What's going on here? All right. My wife asking me questions. All righty. So where was I? S&P 500. What was that? 1.55%, I believe. Yeah, about that. And the NASDAQ, it's going to finish the week off up 3.41%. Wow, big jump. So Dow down, S&P 500 up about 1.5%, and then the NASDAQ up way up. Dow Transport's going to finish the week in the red, down 1.38%, and the Dow Utilities it's going to finish the week down about 0.29%. All right. So actually, let's zoom out and take a look and see how things are lining up right now. It's been a weird few years. Going back to the beginning of 22, we had it was down most of that year. It rallied at the end of in the fourth quarter, sideways for how long was this? About 9 months. We were just really sideways. Had a little bit of a jump at the end of a little bit of a rally at the end of last year, and then it stalled again. And again, another nice rally this year. But again, we haven't really, from the beginning of 20. Let me take those off there. So from the beginning of 22 to now, market's up 5% total. I mean, it's, over 2.5 years, market hasn't really gone anywhere. So anyways, all right, let's get that off the screen. All right, let's go ahead and get to the economic data that came out this week. Starting out with initial jobless claims, came in at 242,000. Forecast was 225. Previous week was 229. Continuing claims came in at 1.82 million. Forecast was 1.8. Last week's number was 1.79. The consumer price index year over year grew at 3.3%, which was not ideal. Forecast was 3.4, so it went down to 0.1%. So I guess that's a good thing. Month over month was flat, so no growth on the month over month. Forecast was a 0.1% growth, and the last month's number was 0.3. The producer price index grew at 2.3%. Forecast was 2.4, and the previous number was 2.5. Month over month, also flat. Forecast was a growth of 0.3. Last month's number was 0.5%. And lastly, the Michigan consumer sentiment came in at 65.6. Forecast was 72.1, and the previous number was 69.1. So you can see here just the last few months. Get out of the way. It just has gone down since it peaked out around, March or April around 80 or just under 80. So, all right. So that is all the economic data that is fit to be shared this week. Good stuff, I know. All right. Hang on. All right. Wife asking questions. She has the day off today. She's going to Europe for 2 weeks, starting tomorrow. I get to drive her out to Denver's finest airport. Her and our oldest and his wife, they're taking 2 weeks in Southern Europe. So that should be exciting. I personally, not going. I hate traveling. So I hate airplanes with my weird arthritis, ankylosing spondylitis, for those who are really that concerned. It stinks to sit in an airplane. It is one of the most painful things I can think of. So, all right, let's go ahead and get to the market recap. S&P 500 takes a breather after recent all-time high as consumer sentiment slips. All right, the S&P 500 slightly retreated on Friday, easing from its recent all-time highs due to a dip in consumer sentiment, although it remained poised to finish the week higher following encouraging data indicating a cooling in inflation. The University of Michigan's preliminary consumer sentiment index fell to 65.6 in June from 69.1 in May. 1 year and 5-year inflation expectations dropped to 2.9% and 2.8% respectively from 3.1 and 2.9% the previous month. Although 1 year preliminary inflation expectation remained at 3.3% for June, it was slightly above the expected 3.2%. Optimism about inflation cooling further was bolstered by May's unexpected drop in producer prices and a slower than expected rise in the consumer price index. This disinflationary trend is expected. Is that disinflationary or is that? Yeah, disinflationary is expected to potentially lead to lower interest rates by the end of the year. And the reason I stopped it, because deflation, would you actually see like prices coming down? Disinflationary means the rate of inflation growth is actually slowing or maybe stopping. So, just because it's slowing down, it's not going this way. So deflation, you'll see it go this way. Meaning it's like deflate the balloon, it's actually shrinking. Disinflation is just the amount of inflation is slowing down. All right. More news here. Boeing shares dropped 2% following reports that the FAA is investigating allegations that Boeing and Airbus used fake titanium in their aircraft. Oh, that's not good. Meanwhile, GameStop shares rose 1% after investor Keith Gill, known as Roaring Kitty, nearly doubled his stake in the company to 9 million shares from 5 million. GameStop announced it would reschedule its annual shareholder meeting to June 17th due to technical issues that disrupted the previous meeting. I mean, the dude's got 9 million. How much is GameStop trading at? Let's just look at that. And, oops, let me get that off this. Where's my chart? Come on, get up. All right. GME. So he's got 9 million shares at $28 each. That is a lot. So 9 million times $28. That's $252 million. Woo! That's a lot. All right. Let me get that off the screen now. There we go. And let me get my other stuff back up there. There we are. Okay. All right. Where was I? Roaring kitty. GameStop. Yeah, we already talked about that. Adobe Systems stock surged 14% after the company reported strong earnings and raised its 2024 guidance, driven by an increased demand for its AI-powered editing tools. UBS raised its price target for Adobe to $560 per share from $540, noting the company's robust ARR guidance and reaffirmed outlook for growth in its creative segment. Tesla shares fell 2% after shareholders approved a controversial $56 billion pay package for CEO Elon Musk and the company's reincorporation in Texas. Good job, Elon. Overall, the mixed market movements were shaped by declining consumer sentiment and individual stock performances amid broader optimism about the potential for lower interest rates driven by a cooling inflationary trend. Again, I don't know what drop in rates, a quarter, a half, even a whole percent. I don't know what that's really going to do for the economy. I don't know why everyone seems to think that is, lowering rates. That's all they've been talking about since like June of 22. I mean, I remember sitting in New Hampshire doing, working on business, and while I was out at Pork Fest, and I remember those were the articles that I was reading at the time. And I'm like, we haven't even solved the problem. Inflation it hadn't even peaked out yet. And they were already talking about how they were going to start lowering interest rates and how that was going to save things. It's like, just having cheap credit, is it, do you think that's all that's going to, boost the economy and keep it going forever? I mean, I don't know. All right, this next article here, Bidenomics implodes, consumer sentiment unexpectedly slumps to 7-month lows in 5 sigma miss. All right. The University of Michigan's latest report on consumer sentiment offers a bleak assessment of the current economic situation. Often referred to as Bidenomics, consumer sentiment unexpectedly fell from 68.8 in May to 67.6 in June, marking the lowest level since last November and the most significant 3-month decline, negative 13.8 points, since the COVID-19 lockdowns. This drop represents a 5 sigma miss from the median estimate following last month's 7 sigma miss. Both current conditions and future expectations took a hit. Current conditions plummeted to 69.6 from to 62.5. Well below the expected 72.2, while expectations decreased from 68.8 to 67.6, far short of the anticipated 72.0. The broad-based decline in sentiment reflects the deteriorating labor market. The unemployment rate rose to 4% last month, the highest in over 2 years, and jobless claims surged unexpectedly, driven by significant layoffs in California. If I could stop there, I wouldn't put any real weight into the employment numbers because they're crap. I mean, they're from the government. A lot of it is just estimates and, plug in surveys into a calculation and it spits out a number. So, I wouldn't look at it. I mean, I would probably put unemployment at, 8-9% right now. Meaning that people aren't in the jobs that they would want or that they're trained for. So I just don't see it being. It's reported as 4%, but I'd put it at least 6, probably closer to 8, and just because of the way. Because there's a lot of people who just said, "Screw it, I'm not working anymore." I'm gonna work for cash or whatever. All right, jumping back in, Joanne Zhu, director of the survey, noted that while lower income families have experienced wage gains in a strong labor market, their financial situations remain tight due to persistently high inflation despite a slowdown in inflation. The inflation outlook continued to worsen. 1-year inflation expectations stayed at 3.3%, slightly above the expected drop to 3.2%, while 5 to 10-year expectations increased from 3% to 3.1%, the highest since November. This dual threat of rising unemployment and persistent inflation suggests stagflation, a period of stagnant economic growth coupled with high inflation, the 1970s. Additionally, the measure of buying conditions for durable goods dropped to its lowest level since December of 22, indicating restrained consumer demand in the coming months. In summary, the University of Michigan's report card on Bidenomics highlights significant economic challenges with deteriorating consumer sentiment, rising inflation expectations, and a weakening labor market, suggesting a troubling economic outlook. I can't disagree with that. All right, one last article here. Comes from the Mises Wire, the real story behind the Fed's soft landing narrative. I put that in quotes. Let's go ahead. And this was written by Ryan McMacken, smart guy. Always love listening and reading his stuff. All right. The Federal Reserve's Federal Open Market Committee, the FOMC, recently decided to keep its target policy rate unchanged at 5.5%, where it has been since July of last year. In his remarks, Fed Chair Jerome Powell emphasized moderate economic growth, strong economic trends, and moderating inflation. Powell stated that the Fed would maintain its rate until it is confident inflation is returning to the long-term target of 2%. Only then would the Fed consider rate cuts to stimulate economic expansion. Powell's assurances of a soft landing, that's in quotes, were where the economy slows just enough to curb inflation without triggering a recession are problematic. I hate that word. That's something that lefties use all the time. Historically, the Fed has struggled to achieve this balance. Often, the Fed denies an impending recession until it has already begun. Weird. Subsequently, cutting rates as unemployment rises. The Fed's predictions have frequently been off base, and its reliance on economic data can be politically influenced amid aiming to keep interest rates low to facilitate federal borrowing and deficit spending. Powell's narrative conflicts with historical precedents during past economic cycles. Rate cuts by the Fed have not led to smooth landings, but preceded significant job losses. This pattern was evident in recessions following rate cuts in 1990, 2000, and 2007. The Fed's recent summary of economic projections suggests a similar scenario, where rate cuts are expected, but economic growth and employment are projected to remain stable, an outcome rarely seen in practice. Moreover, the Fed's motivations extend beyond economic stabilization. It aims to keep borrowing costs low for the federal government. Yeah, because they got all that damn debt, enabling continued deficit spending. The federal debt has surged from $23 trillion to $34 trillion in the past 4 years. Awesome job, guys. With rising interest rates, interest payments on this debt are becoming a substantial burden. In 2024, nearly $9 trillion of federal debt will mature, necessitating new debt at higher interest rates. This will compel the Fed to buy large amounts of debt to keep yields low, regardless of inflation targets. In essence, the Fed's primary goal to manage federal debt rather than In essence, the Fed's primary goal is to manage federal debt rather than solely focusing on employment and inflation. Powell's public statements serve to maintain the central bank's political legitimacy, but the underlying reality reveals a focus on supporting federal borrowing needs. Yeah, they're basically just the printing press for our government. So anyways, yeah, it's a mess out there. I mean, I don't see how I don't see how we're going to get out of this without the republic collapsing. But hey, again, I could be completely off base. These geniuses in Washington could be just like outfoxing us all these years, and now they're going to just fix everything. Nope, I don't think so. I don't think so either. All right, well, that's everything I had for today and for the week. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. If you need to get your financial crap together, give me a call. I'd be happy to help you. All right, well, hope everyone has a wonderful weekend, and I shall talk to everyone again next time. Adios.